Welcome to Financial Strategies with Andrew Agemy in Connecticut and Daniel Agemy in Colorado.
Welcome back to Financial Strategies Radio with Daniel and Andrew Agemy, his father-son team, coming to you talking about financial strategies. Today, we're examining the dangerous myths that markets only go up and solving the retirement conundrum, an intricate and difficult problem that most investors face without even knowing it, because people don't know what people don't know. I'm Andrew Agemy.
And I'm Daniel Agemy. Thanks for joining us today. AAA, markets only go up. That seems to be a thing that's been going around lately.
Well, it's not just lately, Daniel, right? Maybe heavy duty, but it's been going around and around for decades, right? And especially since 1980 when the Dow was at 700 and now the Dow is at, 45,000 or something like that. So, that proves it, Daniel. That proves it. Markets going to go up.
I think it's funny that people can boil it down to that simple. That, you just put your money in S&P or in U.S. stocks and it will only go up over periods of time. Yeah, maybe over periods of time is correct, over 100, 150 years.
Yeah, right.
But people have expirations, right? And so if you want to use the money for anything, then you better be looking at a shorter period of time than 150 years.
Exactly. And that's what people don't know, what they don't know, because Wall Street is an entity that goes on and on and on. And so the market always goes up for Wall Street. But for individuals, time is not on our side. So I agree.
Yeah. So we want to bring up risk reward. We want to talk about risk reward, right? AAA, because if people believe that they're going to make 10% a year in S&P, or that we're going into this AI revolution and markets will only go up, that's fine. They can believe that. We want people to be prudent and to at least have the thought to think about if they should be more prudent at a time like this when, the Buffett indicator is off the charts or the keep ratio is at extreme levels, or if it's time to be super aggressive. And that's all we're looking at today, is to bring, you could say, the other side. If you're listening to mainstream financial networks, they're pumping this stock and they're pumping that stock and they're thinking about investing from today to Tuesday. But we're thinking about clients that we have done for 35 years,
right?
And making sure that they are able to support a retirement and a lifestyle that they want to have. Not just a retirement, but throughout their retirement, have the lifestyle that they want to have and not be dependent on the market gods.
Exactly. And if you want to retire and stay retired, that's what most people want in retirement, is be able to retire, stay retired. Nobody wants to go back to work because they have to. Some people might want to go back to work because they want to, but that's a whole nother deal than if they have to. And that is what we're about, is making sure that people are able to do what they want to do instead of what, they're kind of forced to do because of other things. So right with you on that.
Yeah, so if we look at the Buffett indicator, and it's basically just an indicator, it's named after Warren Buffett, for trying to evaluate if stocks, U.S. stocks, or whatever country you're talking about, are cheap or expensive. The Buffett indicator basically looks at all publicly traded stocks and then divides that by the GDP.
Mm-hmm.
Right? That country's gross domestic product. And so if it's cheaper than 100% of GDP, then stocks are probably going to yield you a nice return. If it's even, they're fairly valued, and if it's above that GDP, they tend to be expensive. And so Buffett indicator somewhere around 200, above 200%, which kind of rivals the tech bubble, rivals some of the highest markets in U.S. history. And if you look at Buffett, he's got tons and tons of cash and tons of energy type assets, things that are paying him dividends. So that's something to consider. Now, some people would say, well, our money's just messed up and we're printing money, so it doesn't matter. But again, we're trying to look at this prudently. Risk reward would say if it's lower than 100%, you have more reward than risk. But if it's at 200%, that's looking at more risk than potential reward, right, AAA?
And that is so important, right? This whole thing is risk versus reward. Is the risk worth the reward? That's what you have to ask yourself. And when you're doing a risk benefit analysis, a favorable ratio is 1 to 3. So the idea that you could go up 3 times what you could lose. So the analogy I always give is, you go to the casino, you got a table, they say, hey, put down $100 and you could make $10 or $20, but you could lose 30 or 40. That's not worth it, right? That should be, you could make $300, but lose a little bit kind of thing. But making a little bit of money, even making $50 on that $100, but losing $40 or whatever, that's crazy. And that's what people are clueless about. That's what people don't know what they don't know. And that's why, we have this show to be able to do that, to be able to help them. And that's why we're coming to you and our listening audience today and bringing you this information. You're listening to Financial Strategies with Andrew and Daniel Agemy, and today's topic is risk versus reward and the conundrum that comes with that. And so we have for you today a white paper that we put together especially for this show that we'd love to be able to put in your hands. And it's called The 7 Risks to Your Retirement. 7 Risks to Your Retirement. And retirement has risk. Life is not without risk. The question is, what is the risk and how are you mitigating it? Or what are you going to do about it? And we have this paper. Just call it by name, 7 Risks, 800-725-7616, 800-725-7616 for your free copy of 7 Risks to Your Retirement. Call now. You listen to Financial Strategies with Andrew and Daniel Agemy because people don't know what people don't know. Daniel, you mentioned in regard to Buffett and how he has tons of cash. He's got tons of dividend paying stocks. He's got other stocks. He's very well diversified, which is great, right? But so many times the average Joe investor, so to speak, doesn't think in those terms. They've got all their money invested in a lot of times, some kind of mutual fund, maybe it's some stocks or whatnot, but typically it's all invested and it's not dividend paying stock. Warren Buffett's got dividend paying stock, so he's getting paid. He's got cash so that he can buy when an opportunity comes. I thought that was very interesting that you brought that point up.
Yeah, that is. And some people would say, well, he's been wrong for a lot of years because he's had cash. He's had cash for a good amount of time now, although he keeps dumping his bank stocks. He keeps dumping a lot of these things and building up more and more cash. But again, it's a risk return. It's a risk reward scenario that he's doing. And he's thinking that the upside isn't good enough to put the capital to work. He could put it in treasury bills and get close to 4%. That's better in his mind than investing it in these stocks that by his own indicator says that they're very expensive.
Yeah. And the other thing when it comes to that, he's got cash. And let's just say, he's probably making 4 or 5%, I got to believe, at least on his cash, if not more. But, remember in the old days when people would have cash that wasn't paying anything. Yeah. And, people would say, oh, I'm not going to put it in cash because, I'm not buying anything. But they don't think about the sacrificial bunt in baseball, right? Where the batter gets up and he bunts it and all the bases run home and the team gets 3 points from that, but that guy gets out. It hurts his batting average, but it's for the good of the team. And people forget about this aspect, that having money in cash. And that's why I think Warren Buffett has that, right? He's got it in cash so that he can have money for good buying opportunities that present themselves, because you never know when they're going to present themselves, right? Now, in our case, we don't necessarily have a lot of cash in our clients' accounts, but we have it in investments that is still available where we can sell high to buy low, which is a cool way of looking at it.
Yeah. And the income streams, right? That's the big thing, because if you're pumping all out 6-7% income on $1 million, that's $60,000-$70,000 a year. Now, assuming you don't have any bonds that mature in the crash, assuming nothing you can sell at a good valuation, which is kind of ridiculous assumptions, but say that's still $60,000 to $70,000 a year that you have there that you can have your lifestyle, or you can reinvest. And when those big sell-offs happen, it's not crazy to get back to even to earn that 1 to 3 type ratio you're talking about. Because if markets cut in half, you're not earning 100%.
Right.
You're not earning 100%. People think 50% you get back to even. 100% gets you back to even. You just made 100%. Right. And if you didn't go down, that you're talking crazy numbers.
Right. And now that's a very good point, Daniel, that you talked about there. Siegel's paradox is sometimes what's that called, from Jeremy Siegel at Wharton School of Business. If you have $1 and you lose 50%, which is 50 cents, how much money do you need? What percentage do you need to make on that money to get back to $1? You got to make 100%. You got 50 cents, you need 100%, you need another 50% just to make it back to even. And people don't think that way when it comes to the market. Oh, the market was down 50%, but now it's up 20%, so, I'm good, or it's up 50%, so I made my money. No, it's got to go up 100% just to make your money back. And you and our listening audience may be thinking, why are we telling you this stuff? Well, the market's going up, but the market doesn't always go up, is the point. And you have to be prepared for when it doesn't. You have to understand the components of risk versus reward. Risk is the possibility of encountering a loss when you can least afford it. That's the key, when you can least afford it. It's not risky if you can afford it. So it's especially devastating in retirement. Think of the people in 2008 that they were they were more risk, favorable than they should have been, and they couldn't retire when they wanted to retire in 2008, or they had to go back to work. That's crazy. That should not happen. What's the reward? Well, the potential benefit from your investment decisions, but are today's potential rewards worth the massive risk? I don't think so, Daniel. We see that the S&P over time does maybe 9%, give or take, and it doesn't do it every year. Some years it does 30, some years it does, -5 or -20, whatever the case may be. But we've seen consistently returns of between 6 to 7, 9% per year average over time. Right?
And that's why we're talking about risk versus reward, because you don't always have to be invested in stocks. You can look at the risk-adjusted returns, and you can look at some of these indicators, like we're going to get into this other CAPE ratio, which explains another way you can see if things have a better outlook for the next 10 years, or if they have a lower or negative expected return for the next 10 years.
Okay. All right. This is good stuff. And because people don't know what people don't know. And the key is having the strategies that fit what you're trying to do. It's not as important as the investments. It's not as important as the planning. What's important is having the right strategies, because the proper strategies work. And you're listening to Financial Strategies with Andrew and Daniel Agemy. Risk versus reward in a market that only goes up, so to speak. And we have, we have something that we want to give you today. We've got a video book. It's 3 different animated videos that we'd like to give you. A very unique thing that has educational value in regard to whether it's required minimum distributions, how to get income, history in the stock market, Social Security. All these different topics several different topics can be on this book. And we love to give that to you for the next 5 first-time callers at 800-725-7616, 800-725-7616 for your free copy of the video book. Call now.
The biggest mistake retirees make is not switching from the growth model to the income model. A good retirement plan is having enough income to last the rest of your life. Any problem in retirement, it can be solved with income. The biggest concern that retirees have is running out of money. The second biggest concern is that they want to grow their money so that they don't run out of money. And they think it's synonymous when it's not necessarily the case. People don't know what they don't know. And they're not going to know unless somebody tells them. People think that the only thing that they can do to grow their money is by investing for growth in the stock market. And it's very much a herd mentality. But you can only get growth when the market goes up. When they invest for income, they're able to get money no matter what happens. I'm Andrew Agemy, founder and CEO of Agemy Financial Strategies. We've been helping people enjoy stress-free retirement for over 30 years.
You're locked on to Financial Strategy with Andrew and Daniel Agemy.
And welcome back to Financial Strategies with Andrew and Daniel Agemy. And today we're talking about risk versus reward in a market that only goes up, or so to speak. Now, the key and what we were just talking about was the aspect of the market and what's happening and investing in different forms and fashions. And we talked about strategies versus planning. And many people plan for growth, Daniel. But if you have a strategy that encompasses the risk reward scenarios properly, it's a different deal. And, what I see is, we see situations that happen like that, whether, in history, we know people that have gone through the wrong things. We have seen different things,
Yeah, absolutely. We have a bunch of stories even prepared for today to go through some of those AAA. But let's keep talking about the risk reward, right? Do we think there's more risk or more reward potential in, let's just say, S&P, U.S. equities, right?
That's a great question. And we could break it down even further than that, right? Because you can talk about the index as a general thing, right? Which is one thing, right? Because individual stocks are one thing, but then you get mutual funds and that's another thing. But we won't go there right now. But what's the possible reward? What's your outlook? One of the things I always ask people, the market's gone, over the past 25 years, the market's had these big swings up and down and whatnot. And, what's your thought? Do you think the market's going to grow, or do you think the market's going to continue to have some ups and downs with it? And typically people say, well, I think it's going to have some ups and downs with it. If you think it's going to have ups and downs, why would you put, 100% or 90% of your money in something that it only changes in your favor if the market goes up?
Right. And that's where, if we look at CAPE ratio, right? Robert Shiller put this together, and it's become a real accurate way of measuring valuations of the S&P 500. So it looks at price per earning, but it doesn't look at price per earning for this year. It looks at the average over the last 10 years for the S&P 500 stocks. And then you divide that by the current stock price. And if you get somewhere between, the average is probably 16 to 17. And so if you're around that 16 to 17, you're probably going to get average stock market returns, right? That would make sense. If the average PE, you're going to get average returns. If you're above that, you need to expect less returns, right? Right. So a high is 25 to 30. If you invest at a 15, you're probably going to do better returns than the average, right? This is making sense, right? AAA. Yeah. If you invest at more than average PEs or CAPE ratio, you're probably going to have lower than average returns over time. And if you invest at lower averages, you're probably going to have higher returns over time. Well, we're somewhere around a 38, which is like off the charts almost. This is higher than the tech bubble.
Right. And, to put that in terms that where, people can understand, put in terms of houses, right? If you can buy a $400,000 house for $300,000 or $250,000, you jump all over that thing, right? And you'll make some money one way or the other. But if you pay $500,000 for that house, this is not exactly with what you're saying with the PE ratios, but just helping people understand that if you buy it right at $250,000 or $300,000, you make money when you buy it because the house is it's worth $400 or can be very easily. But if you pay $500 for it, you're upside down right from the get-go. And that is so much what's happening because as we've talked about on previous shows, it's just people, these when you put money in your 401k and it goes into the market. So the managers of those funds that you're putting in have to buy stocks, whether they're good or they're not good. They have to buy them. And that is, one of the conundrums that we have with this whole risk versus reward thing.
Exactly. And that's partly what drives these, like the Buffett indicator, the CAPE ratio. That's partly what drives those higher, is because people are now looking at risk reward. They're looking at what they've made. They're looking at the past, what they've made, not what the future is, the next 10 years. Right. And so that money is forced into certain stocks, which drives the price up, which gets more people excited that the returns will be like they were in the past, which drives more money. And it's this virtual cycle, right? It's this self-fulfilling prophecy. And this is not a new thing. This has been happening for hundreds of years.
Right.
And then eventually people realize that risk is not a good risk adjusted return. And something pops that cycle, and people go from euphoria to desperation. And that's when there's good buying opportunities again. But by that time, most people don't want to touch stocks with a 10-foot pole, right? They don't want to they've been hurt too much. And so a simple suggestion is, when things are trading at, if a CAPE ratio is 35 to 38, which historically the next 10 years has been 1.5% to negative. Did you hear that? When the CAPE ratio is above 35, we tend to have the next 10 years average returns of 1.5% to negative. Wow. So one of the things people can do is just switch from equity, especially expensive equities, to cheaper equities that maybe you go to a different market. Instead of S&P, you go to an international, or you move into credit, which could be the same as S&P 500 companies potentially. But now you're buying a contract where you know what your return is for the next 10 years because you have a contract saying we will pay you this. And as long as those companies stay in business, you get your money back. And you collect whatever that return is. Maybe it's 6% or, depending on interest rates.
Exactly. And, that's interesting that you talk about that, because there's insanity going on out there right now in the market, right? And for you and that are listening audience, you're listening to Financial Strategies with Daniel Agemy. And today we have a book that we'd like to give you. It's called Financial Insanity: How to Keep Wall Street's Cancer from Spreading to Your Portfolio. And talking about history, it talks about history in the stock market. It's a little bit of an older book. I think it was written 2011 or something, but nevertheless, written by David Scranton, CFP, as well as it got his master's in financial services. And it's a great, easy read book, very easy read book that will benefit you and help you educate you further. 800-725-7616 for your free copy. No obligation to the first 5 first-time callers. 800-725-7616 for your free copy of Financial Insanity. Call now. Listen to Financial Strategies, because people don't know what people don't know. And Daniel, as that's very interesting, that CAPE index and what you're talking about in regard to those things. But so it's saying the CAPE index is saying that the risk is not worth the reward. Doesn't mean that you can't invest in the stock market. Doesn't mean you can't make money. It's just that the regular traditional way of doing it is the risk is not worth the reward.
Yeah, well, we see it with all kinds of stuff. There's favorable times to participate in things, and there's non-favorable times to participate in things. And the best you can do in life is try to add more when it's favorable and take some out when it's less favorable. That's as simple as it is. What we're talking about, risk versus return, is when it's favorable, you add more to it. And when it's less favorable, subtract some out. That's all. That's just common sense. And people are probably laughing yeah, that's common sense. But we don't do that in the moment because there's hype and there's excitement and there's euphoric energy, right? That we need to continue on. We want to participate in. I think it was JP Morgan who said there's nothing harder There's nothing harder for the human consciousness to watch your friend getting rich while you're not.
Right. Right. Emotions, right? Emotions are difficult. And that's why it's so important to be able to have somebody else. That's where when you have a professional handling your money from that standpoint, that they tend to get they're not free of emotions, but tend to be able to make smarter decisions because they're not as emotionally tied to the money as the people who actually own the money. So that's a most important, very important thing.
Yeah. And there's another thing, AAA. When we're talking about some of those stories you had mentioned, there's a story about Margaret's nightmare. And basically in 1929, she had maybe $100,000 and she decided to retire. And it seemed like a great time, right? Everything's booming. Things are doing well. I think we all know what happened in September 1929, right?
Right.
And markets fell apart. Now, wisdom, right? Investor wisdom, tells us that if you only draw 4% out of your portfolio per year, you're going to be fine. And that doesn't work if you happen to be investing at a high, because averages fool us. And so you're not working from an average, you're working from a peak. And so she retired in 1929, and she had two choices in 1932 when her portfolio was all the way down to $36,000. Now, $100,000 that she retired on was closer to $1.5 million back then in today's purchasing, in today's dollars.
Okay.
But she was down to $36,000. And so she had a choice. 4% of the 100,000 is 4,000. 4,000 she needs to live off of is a huge portion of that $36,000.
All right.
So she can put her retirement on hold and not take that money anymore. She can go get a job. Now, neither of those, there's not really an option, right, AAA?
Yeah. I mean, neither of those in my mind are options.
Because you saved up for retirement. Now, if she had not done what was the industry's definition, the 4% rule, and she had just gone to trying to invest in dividend paying alternatives and got 6 to 7%, just say 6%, she would have come through that, been able to get her $4,000 a year off of the 100 and had $2,000 to invest as the markets crashed. And we talk a lot about dollar cost averaging and reverse dollar cost averaging. And here's an example of how you can still dollar cost average and still support your lifestyle, because she would have had $2,000 to reinvest into that portfolio as the stock market crashed down.
Exactly. And that's crazy. I want to talk more about the risk, right? And that's a great example of risk, the possibility of encountering a loss when you can least afford it. And that was devastating to her in her retirement. And that is the problem. But she could have done something differently prior to that. But she had to do it prior to that moment. That was too late to do it then. But if she did it initially, and that's the key, is being proactive with this. You're listening to Financial Strategies with Daniel Agemy. Today's topic is reverse reward in a market that, quote, only goes up. And so today what we have to give to you, or we have an RRR, Retirement Readiness Report. A lot of people say, can I retire? When can I retire? How can I retire? Give us a call. We'll help you understand how you can do that and how you can receive this report. 800-725-7616. 800-725-7616 for your free Retirement Readiness Report. Call now, 800-725-7616.
This is Financial Strategies with Andrew and Daniel Agemy.
And we're back. Welcome back to Financial Strategies Radio, where today we're talking about risk versus reward. Risk, the possibility of encountering a loss when you can least afford it, especially during retirement, and reward, the potential benefit from your investment decisions, but are today's potential rewards worth the massive risk? I'm Andrew Agemy.
And I'm Daniel Agemy. Thanks for tuning in today. AAA, when you're talking about risk, and the definition that you just gave about being forced to sell, that's exactly what happened in Margaret's nightmare, right? When her portfolio crashed in retirement from 1929. And a lot of people will say, well, you just had to wait. If you waited from 1929, I don't know, I think it was the 50s before it got back, early 50s before it got back to even. But that's not even what we're talking about here, because what we're talking about is she didn't get the $4,000 a year she needed to live on. And if she continued to take that, she's forced to sell in the absolute worst possible time. She's forced to sell at fire sale levels when you should be buying. And that's why we look at some of these indicators to say if it's a more advantageous time to be in equities or it's a less advantageous time to be in equities.
Right. And the other thing that people don't know, that what they don't even know, is required minimum distributions. So right now, when you're somebody 73 years old, you have to start taking required minimum distributions out of your IRAs or 401ks. And if over those people born, I think in 1959, 1960, it will be 75 years old. No longer is it 70 and a half. But the point is, at some point, the government says you have to start taking money out. And if you have to take it out when the market is down, that is suicide to your portfolio. And, so there's a lot more to it. There's a lot more to it. So how about Robert's lost decade? You want to tell us about that?
Yeah, what's that about?
Well, Robert retired at the dot-com peak in 2000, right? And, with a sensible portfolio, what everybody's talking about, or what sensible, again, quote, we're using a lot of quotes today, right? Air quotes. Sensible portfolio of 60-40, right? 60, that's 60% in stocks and 40% in bonds, although we know they're not real bonds, they're bond funds, right? Generally speaking. But between 2000, 2002, 2008, 2009 crashes, he endured 13 years of watching his nest egg shrink while still needing income to live. Right. And traditional risk reward analysis failed him completely. He wasn't prepared for what happened in the market.
And that's one of the things. Both of these are things, if you're using AI to help you model your portfolios, if you've got most financial advisor, these are the sayings, right? It's time in the market. If you only draw 4%, you're going to be okay. The 60-40 portfolio is the way to go. That's how you get through retirement. And we're not in usual times. I think in my lifetime, we'd had like 3 1 in a trillion type events. Like 1 in a trillion years, these types of market events are supposed to happen once in a trillion years. And I've had 3 of them in my lifetime. So we're not in ordinary, right? AAA, we're not in the ordinary times. So these mantras that have come from Wall Street, right? 4% rule, 60-40, it's time in the market, not timing the market. These types of things, they're not your friend. We'll put it that way.
Yeah, well, it all comes down to the money, right? Wall Street makes money when the market goes up, it goes down, it goes sideways. When do people who are invested in the market make money? The normal retail investor, only when the market goes up. So Wall Street's gig is they want as much of your money in the market for as long as possible because they're going to make more money on it. Then they don't care what you make, which is a self-seeking methodology, as opposed to they know that people can make money by investing for dividends and interest, but they don't want to talk about that because they don't make anywhere near as much money as having it in the stock market. So, it's purely looking out for number one from my perspective. But, the key there is, I think, Daniel, definitions too, right? And when people say, oh, I got to go high risk, I need to make money, so I got to go high risk. Well, just because, high risk doesn't mean you're going to make money. If it meant that you were going to make money, it wouldn't be high risk.
Right. And it's those favorable times, right, AAA?
Right.
Like you go high risk when it's a favorable time for that. Now, that doesn't mean you're going to win still, but you need to do it when it's a favorable time. If you go high risk is my friend, but we're at all-time highs. That does not make sense. We're at bubble-ish market valuations. That doesn't mean it's going to turn around tomorrow. That doesn't mean it's even going to turn around this year.
Right.
But it means risk is not your friend at that point in time.
You're listening to Financial Strategies with Andrew Daniel Agemy. Today, we're talking about risk versus reward. And talking about that is, we just talked about the 60-40 portfolio that many advisors talk about and 40% in bonds. But unfortunately, many times they're talking about bond funds, which bond funds are different than individual bonds. We have a paper that we put together today to help you educate you further on that called Beware of Mutual Fund Risks in Retirement. And we love to be able to put this in your hands for free to be able to help you be able to understand more about what happens with mutual funds and how they can be risky in your retirement, where the risk is not worth the reward. We love to put that in your hand for free by calling us at 800-725-7616, 800-725-7616 for your free copy of Risk in Retirement, Beware of Mutual Funds. And listen, Financial Strategies, this father and son team coming because people don't know what people don't know. Daniel, I'm having a good time today with you, going through this risk reward thing, trying to educate these people in our listening audience. I'm sure a lot of them are not aware of many of the things that we're talking about. You want to tell us a little bit about the Japanese, what happened with the Japanese stagnation?
Yeah, well, AAA, the Japanese market is, I think, something people in the U.S. don't pay a lot of attention to, but this is a big deal for people in Japan. And in the 1980s, that was the booming market. That is where everyone was making money. They were making money in everything, in housing, in stock markets. Money was flowing. They could leverage a home, buy equities, leverage the equities, buy homes, leverage the homes, buy equities. And it was this perpetual cycle. It kept compounding on each other. And people just thought it wasn't going to stop.
And in the moment, you don't think it. Yeah.
There was a point in time where the garden in the emperor's palace was valued in dollars, was valued for more than all of California. Yeah. And so it was crazy, but people were caught up in the moment, right? Yeah. It only goes up. This had been going on for some time, and it didn't matter what you did, you made money. They experienced a crash in the early 90s, and it took 35 years to get back to even for the Nikkei, which is basically like their S&P 500, to get back to even. 35 years. People here in the U.S. could not even fathom 35 years of a down market because we've been so rewarded and our companies have been so good. The point isn't to say that we're going to have 35 years of nothing here in the U.S. The point is sometimes when things seem to be too good to be true, or money is free, or it doesn't make sense how these magical numbers in your stock portfolio keep going up, right. It's time to be more prudent because you don't want to have a flat period of time, especially in retirement.
No, that's the worst time to have it. It's one thing when you're 50 or 40 or whatever, right? But in retirement, that's why people, they're fearful about running out of money before they run out of life. And it's because they don't change their strategy. Properly. But, there's a common thread between all of these, right? The Japanese, Robert's lost decade where he didn't make any money, Margaret's nightmare, all these things is they have a dependence on asset sales rather than selling their assets, selling their investments, rather than income producing retirement investments. Because there's a huge difference. And, they're still in the accumulation mindset as opposed to the distribution mindset.
Yeah. And that's the way people are taught these days is assets always go up. So you sell assets when you need money to support your lifestyle. And as long as everything's going up, as long as there's this euphoria, as long as the flows keep going, it can work. But what do we know from history is
they don't keep going.
They don't keep going, right?
Yeah, the predictable and repeatable trends that show that they don't always go up. I mean, the market goes up, down, and sideways, and it goes down and sideways more often than it goes up.
And so the point is to evaluate your risk. Is it too much risk? Are you taking on too much risk for the point of the cycle we're in? And if you don't know how to evaluate that, then get some help to evaluate it. But you need to make a conscious decision if you're taking that much risk on purpose.
Yeah.
Or it's just whatever will be. It happened. Because you're responsible for that. And if you have a spouse and you're responsible for you and your spouse because you're the one taking care of the money, even if you have an advisor, you need to evaluate that and say, am I taking on as much risk as we want to take on? Or did it just happen because things went up so much and now we're taking on more risk than what we had originally planned? Or we're closer to retirement or we're in retirement and it's too much risk for retirement. It might not have been too much risk because you were 38 years old and you had a good income, but now you retired and you don't have that income. Or you're about to retire, you don't have that income. So that's what we're trying to get people to do is evaluate your own risk. You need to do it before you're forced into a sale and you're doing the opposite of that quote. I think it was Rothschild that said, you buy when there's blood in the streets. And they were literally talking about blood in the streets because back then it was during a war and they were buying up lands and banks and all kinds of things during the war.
Sure, exactly. Yeah. It's something. So anyway, we're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is risk versus reward. Is the risk worth the reward? And we have a video book that we'd love to be able to put in your hands. This shows animated videos educating you on various retirement-related topics. And we'd love to put this book in your hand for free, no obligation, to the next 5 first-time callers at 800-725-7616. 800-725-7616. Call now for your free copy. Next 5 first-time callers.
Do you have any questions for me about retirement income source?
I just want to make sure I can invest well enough to have enough income, enjoy my retirement.
We build a custom retirement plan based around your income and goals.
How do I know I can trust you?
Building trust does take time, but our investment advisory arm is comprised of fiduciaries, which means our obligation is to you. So you can enjoy your retirement with a little more income stability.
I'm in.
That's 2 out of 3.
You're locked on to Financial Strategies with Andrew and Daniel Agemy.
And welcome back to Financial Strategies Radio with the father-son team of Andrew and Daniel Agemy, coming to you because people don't know what people don't know. Today we're talking about risk versus reward in a market that, quote, only goes up, unquote. And I'm Andrew Agemy.
And I'm Daniel Agemy. Thanks for tuning in. AAA, today we're talking about risk versus reward. And this is something that there's a lot of talk about markets. There's a lot of shows you can listen to, a lot of voices out there, a lot of information. But this is one of the most basic concepts in investing is risk versus reward. And I don't hear almost anything about this from anybody, right? Why is such a basic concept of looking at your risk versus your reward and then evaluating your position based off of that not talked about more often?
Well, it doesn't benefit Wall Street, number one. Right? Because, if people actually took time to use their brains, to be responsible for their money, how their money is being invested, right? They would say, oh, wait a minute, this reward is not worth the risk right now. with this? Or what are other ways that I can do this? I talked to one of our listeners the other day, Daniel, and he was talking about taxes and about selling properties. And well, how can I mitigate these taxes that I'm going to have to pay when on the capital gains of these properties? And he knew that there must be some ways to do it. There's only so many ways, but when it comes to managing risk and mitigating risk, there's a lot of different ways. And let's talk to our listeners about the aspect of mitigating risk today and getting a better reward for lowering their risk, increasing their return, increasing their paycheck.
Yeah. I think the free lunch in investing is diversification, first off, right? And diversification doesn't mean collecting funds. Diversification is looking at real asset classes, different asset classes. Mm-hmm. It's not putting everything in a fund, because here's what happens when there's certain things that aren't supposed to be traded. You hold them. And so when you wrap things like private credit, or you wrap things like corporate bonds into wrappers that people trade, what ends up happening is in big sell-offs, people sell those things, but there's not really a deep market for it. And so they gap down. So when you buy, let's say, corporate bonds in a fund, not only do you lose the two guarantees you get with a corporate bond, right? You get your return of principal as a contractual guarantee, and you get coupons or payments twice a year as a contractual guarantee.
Nice.
And you put that into the wrapper of an ETF or a mutual fund, you lose those two contractual guarantees, but you also take on this risk where if other people get freaked out and start selling that asset, it gaps down because too many people are selling something that shouldn't be sold. You don't need to sell it because it's still going to pay you. And that causes even more chaos. And so because Joe Schmo down the street decided to sell, the fund manager has to sell your bonds. Yeah. And that negatively affects the NAV. So your assets drop down when they shouldn't because somebody else is selling your investment, right? So besides the fact that you give up those two
guarantees,
contractual guarantees, it creates volatility in the portfolio that shouldn't be. So whenever we wrap these things up into these funds, you start losing the diversification. Obviously, if you own a real building and you collect rents off of it, it's going to act differently in a market sell-off than if you own an ETF that owns buildings.
Right.
And so a lot of things in our 401ks and our portfolios, we need to own a securitized version of it.
Right.
But there's different ones that respond differently, and getting closest to the actual asset as possible is your most, let's say, advantageous or risk adjusted, right? It gives you the highest reward for the lowest risk if you can get closest to that asset as possible.
Right. And, that reminds me, Daniel, that, with what you just said, I think I want to give away the paper bonds versus bond funds, right? So that people can get, a little bit more education with that. So if you're in our listening audience and you want that paper, bonds versus bond funds, it shows you there's a big difference between individual bonds and bond funds, what Daniel just went through with that. And people don't know the difference. Many times. I mean, I've talked there many years ago. I talked to a guy that had been in this business for 20 years, and he didn't know the difference between bonds and bond funds. Can you believe it? And so many people, when they're talking about bonds, they're talking about bond funds, and that doesn't work the same. And so I want you to have the right definition. So call us for your free copy of Bonds versus Bond Funds, 800-725-7616. No obligation, 800-725-7616. Bonds versus Bond Funds. Call now. You listen to Financial Strategies with Andrew Daniel Agemy. Risk reward in a market that, quote, only goes up. Daniel, I love the idea about diversification, and that's a key thing to help mitigate this stuff. True diversification, as I like to call it. And most of the time, what people have is like ships on the ocean. right? It doesn't matter if they're big ships or small ships, motorboats, sailboats, old ships, new ships. Tide goes out, they all go down. Tide comes in, they all come up. And that's what most people have in their portfolios for diversification, which is not true diversification. Whereas what you've been talking about is completely different classes of individual positions. So if something is down, something else is up. And so you can sell what is high and buy what is low, which is the whole thing about business and investing, right? Buy low, right. Sell high. But if you're in the market, that's a very hard thing to do. And you're kind of stuck. And that's why I say, well, wait it out. For people, who are in and close to retirement, time is behind us rather than in front of us. And we don't have the time to wait it out.
Exactly. And think about this, AAA. We talked about the crazy Japanese market in the 80s, right? Mm-hmm. What if, when that lily pond in the Emperor's Palace was valued at more than all of California, if you had taken some of your money, you said, this market seems bubbly.
Right.
I'm going to go invest some of my money in U.S. markets and U.S. real estate. The next 35 years, when Japan got back to even, how would that money, that diversified money, right. How would that have worked by having invested in the U.S. for those 35 years, right? And that's what we're talking about. We look at expensive markets, and that doesn't mean it's crashing tomorrow. But what right. It does mean is it's time to diversify into something else that doesn't look expensive, that looks cheaper, and that can protect your hard-earned money. But even more than that, AAA, is investing, if you're near to or in retirement, into the pay me model. Because when you get paid, it opens up freedom. It opens right. up confidence, right? When you have a portfolio that can pay you, your $1 million portfolio can pay you $60,000, $70,000 a year of income, yeah. Then you don't have to worry about when markets are crashing. You're not forced to liquidate. You're not forced to take your RMD out of your principal. You're not forced to pay your bills out of your principal, right?
Right. Right. It's a beautiful thing when our clients are automatically getting a paycheck from their investments as opposed to having to sell assets to get money to live on. There are two different ways of doing it. And getting a paycheck automatically from the dividends and interest from bond and bond-like instruments is a phenomenal thing. And you don't have to give up growth for that, is the beautiful thing that people don't know what they don't know when it comes to that. It's that brings us to the aspect of it, the mathematics of superior risk management, right? It's not a guess. It's not hope.
Right.
It's mathematics.
Exactly. It's mathematics. That's when you're investing in contracts. It's no longer hope, but you have mathematical certainty, what could be better than that when you're talking about retirement? AAA, what about helping the listeners align their decision-making, align maybe where they stand as far as their risk tolerance? They might not have done any type of assessment like this in some time. And when we go through and we talk about how, the Buffett indicator or some of these other metrics for measuring markets are at crazy bubble valuations, is it a good time for people to look at their risk? Or maybe you could give people an outline of what the average risk looks like for individuals.
Help me, what the average, my mind was thinking on one track, Daniel, what the average risk for individuals.
Risk seeking, right? How would you identify? I'll change it. How would you identify, maybe a risk averse, risk neutral, risk seeking type people, so they can get an idea. If you're risk seeking, I still wouldn't say invest in U.S. equities right now. On a whole, there's some good deals out there, but not everybody is risk seeking at this point in your life. What do you think, AAA?
Okay, so that's a very good point. The risk adverse people, the conservative people that they don't want to lose money. Everybody wants to make money, right? But these people don't want to lose principal. And then there's the people who are risk neutral, more of a moderate kind of investor. They'll take on some risk, but they don't want super risk. And that makes, in my mind, those two make the most sense in retirement to make sure that you don't run out of money in retirement. And then there's the risk-seeking, the aggressive people. Sometimes I really wonder why they're doing that. Maybe it's to show their neighbor, hey, look at my account. Look how much I'm up. I'm up 50% year to date, and, that's a great thing, right? But is that really helping you in your retirement? It depends on different people, right? But the key to this whole thing is, what are you? If you don't know, if you and our listening audience, if you don't know what kind of investor you are and where you fit in that realm, you need to find that out. You need to be asked that question. And you need somebody that's going to look at your investments from your definition, not their definition. So many times, it's like, 15, 16-year-old kid, hey, son, are you done cleaning your room? Hey, daughter, are you done with your homework? Yeah, Dad, I'm done. Yeah, Mom, I'm done. And then you go check it, and it's not, your definition of done. And that's what happens with investments. People say, I'm conservative. So they put you in an aggressive, the conservative end of aggressive, as opposed to the conservative end overall, right? Where you could be in the aggressive end of conservative, but that's not what they do. And so, what we want to do is be able to make sure that what we want you to be able to do is use your definitions, make sure that somebody is honing in on what and defining, making sure they're clear on what your definition of risk and making sure your investments meet your definition of risk, not somebody else's definition of risk. Because so many times people will say, I'm a conservative. I think 10% of my money should be in the market. And I look at their portfolio and they got 90% in the market. They're set up to be aggressive. And they say, that can't be. My advisor knows that I'm conservative. They're using different definitions. So get with somebody that's going to use your definitions, please. Now, I see that we're running out of time today. And so as we part, you're listening to Financial Strategies, Andrew and Daniel Agemy. We've been talking about risk versus reward. It's been fun being with you today. I'm looking forward to hopefully being able to talk to some of you people, because that's when I really get, my adrenaline going, when I'm actually able to talk with you. If you have a question or whatnot, call us 800-725-7616. Also have a retirement readiness checklist. People want to know, am I ready to retire? How can I retire? When can I retire? And this readiness checklist will be able to help you with that. You can call for and get that for free, 800-725-7616. Retirement Readiness Checklist, 800-725-7616. Okay. And just remember that educated retiree is a happy and stress-free retiree. Until next time, we wish you happiness and stresslessness.